Hey, hello, welcome back. So in this video what we are going to do is we are going to cover the eighth topic of ESI, that is fiscal policy. So we have covered about 7 topics till now. If you have not if you have not watched the previous 7 videos, what you can do is go on to the playlist section or the course section of the YouTube channel, and there you can find a folder or a course called ESI. In that, the rest of the previous videos are arranged chronologically. So without any further delay, let us begin. So today I'm going to read fiscal policy. Let us have a brief overview of the following topics. So introduction. Fiscal policy refers to government's approach to managing its revenues and expenditures, which together constitute the national budget. Okay, through this policy the government adjusts its spending or income levels to regulate and influence the country's economic activity. Okay, fiscal policy deals with both quality and method. Okay, types of fiscal policies: expansionary fiscal policy and contractionary fiscal policy. So actually I have studied this in very detail in my UPSC economics preparation. So I would explain this in just 2 lines. What is expansionary policy? It is a policy where the government pumps in more money into the market to encourage investment, to encourage more spending. That is expansionary. That means government is pumping, or money is being pumped into the market. That is called expansionary, where government itself is spending more money. So I think it is there, pump up, priming, etc. So what is contractionary fiscal policy? It is basically the opposite of expansionary. Contractionary means that the government is not spending money and the money from the market is being taken out and money is very scarce. Okay, so that is what we are calling it as contractionary monetary policy. Then we have cyclicality of fiscal policy. Counter-cyclical fiscal policy. The counter-cyclical fiscal policy refers to a strategy adopted by government to counteract the effects of a boom or a recession using fiscal tools. Okay. Pro-cyclical fiscal policy is a policy works on the same directions as the ongoing business cycle, thereby intensifying the economic fluctuations. For example, during a boom, if the government increases spending and avoids raising taxes, the boom is further strengthened. Okay, that means going with the flow, going with the economic outcomes. Then we have components of fiscal policy. Government fiscal policy works as a tool for development, managing its receipts and expenditures. We have 2 categories. We have revenue receipts, capital receipts. We have revenue expenditure, capital expenditure. So let us keep the things simple and let us not complicate things. First we have revenue receipts. Revenue receipts neither create a liability for the government or reduce its asset, hence they are termed as non-redeemable assets. Revenue receipts are basically tax revenues or non-tax revenues. They are collected from personal income tax or corporate tax, excise duty or custom duty, and non-tax revenue is just well known. Then we have capital receipts, either create a liability or reduce its assets. Then example is disinvestment from a PSUs reduces government owned assets. Okay, revenue expenditure, it does not lead to any creation of physical or financial assets. Capital expenditure creates physical or financial assets. I think basically every candidate who is preparing for any competitive exam knows what these concepts are, but let me just tell you in brief what is a revenue receipts. Revenue, when the word receipts comes, be it capital receipt or revenue receipt, just remember that when the word revenue comes, you get to know that the money is going into your pocket, the money is coming into your pocket. As a result, it is called as receipts. So what does revenue receipt say? Revenue receipt is saying that money is coming into my pocket as my revenue, and it is coming on monthly basis or yearly basis depending upon whichever is the tax. So if I am the government, then I am receiving direct taxes year on year basis, indirect taxes like GST collections, etc. So this is called as revenue receipt. Like, it is a revenue of the government which we pay to the government and government earns, and it is not one-time payment, it is a recurring payment, hence it is called as revenue receipts. What is capital receipt? Capital receipt is what? Capital receipt is same as revenue receipt, but just remember that in capital receipt you get the amount as one-time payment and it is not recurring. That means it is not ongoing payment, and it creates a liability, and it also reduces an asset. For example, I am selling off a company of government like ONGC, or I am selling off Indian Railways to some private player. The money that I would get out of it is a capital receipt. Okay, just remember that. And similar is the case with revenue expenditure. The money that I am spending on a day-to-day basis, that to pay the salaries, to pay the daily expenses, like to pay the electricity bill of a ministry or a government office, that is called as a revenue receipt. I'm not getting anything in return by paying an electricity bill. Okay, so that will be categorized as revenue receipt, revenue expenditure, sorry. Then we have capital expenditure. Capital expenditure is everything like construction of roads, like building airports, highways, etc., which creates a fixed asset for the government, is called capital expenditure. Let's move ahead. Functions of fiscal policy. We have allocation function, distribution function, stabilization function. Allocation function: certain public goods cannot be provided by private enterprises due to lack of profit opportunities. Examples include national defense cannot be provided by a private company, government administration, public services like affordable housing, water supply, free education. Okay, government assumes responsibility for supplying these goods. Okay, distribution function. Societies consist of both rich and poor. Government aims to narrow this gap. It collects funds from the wealthy through taxes and redistributes them to through subsidies, welfare schemes, provision of free education, and human capital development. Okay, then we have stabilization function. Government intervenes to correct fluctuations in income, employment, prices, and inflation. Okay, fine. Then we have fiscal imbalance. Fiscal imbalance refers to the difference between total expenditure and total receipts from both revenue and capital accounts combined, okay, which is causing a deficit or a surplus. That is called a fiscal imbalance. Either it can be positive, either it can be negative. Then we have types of deficits. That means we are in a deficit. What does a deficit mean? Let us see. Fiscal deficit refers to the gap between the government's total expenditure and its total receipts including borrowings. So we have a formula: gross capital deficit is equal to total expenditure minus revenue receipts plus non-debt creating capital receipts. Note, non-debt creating capital receipts are those receipts that do not involve borrowing and therefore I get it. Just remember fiscal deficit as something that we are having a deficit in terms of monetary value, where the spending is more than the amount of the value of money that we are earning. That means we are in loss. Then we have revenue deficit. Revenue deficit is revenue expenditure minus revenue receipts. I have explained these two concepts earlier. So primary deficit. Primary deficit is obtained by subtracting interest payments from the fiscal deficit. This is important, primary deficit. So there are concepts like budget deficit, primary deficit. You need to be well versed with these concepts. Then effective revenue deficit is the difference between revenue deficit and the grants in aid. Okay, so whenever the word effective comes, just remember grant in aids must be added or subtracted accordingly. So here we have I think we have added the grant in aid also, so that is effective revenue deficit. Monetized deficit. Monetized deficit is just deficit caused by printing of new money. This is also called as extremely inflationary in nature, unable to raise funds from the market to finance the government. Actually, Venezuela did this kind of thing earlier, where it was not able to pay loans. So what it did was it just printed its own currency with millions of rupees or millions of its currencies. So what happened was it led to very inflationary effect. Okay, so this is monetized deficit. Then we have fiscal deficit financing. Gross financial deficit is equal to total borrowings. Borrowings include, okay, need for deficit financing, inability to mobilize sufficient public sector surplus, then rapidly rising expenditures. Okay, consequences of deficit financing: increase in production, employment opportunities, economic development, disadvantage, inflationary spiral, impact on GDP, crowding out of private investment. Crowding out of private investment means there is no fund left for private investment. Measures to check fiscal deficit. Just give me a second. This thing right here, and let me just wait a second. Let me do this. Measures to check fiscal deficit: reducing government expenditures by rationalizing subsidies. That means the schemes that are currently going on, like Ladki Bahini Yojana, etc. So what we are doing is we are just giving them free money as an incentive. Okay, so what we should do is basically we should avoid giving free subsidies like these. Reducing revenue expenditure, curtailing other unnecessary avoidable revenue expenditures. Okay, then we have increasing revenue by increasing the tax base, preventing and controlling tax evasions, reconstructing public sector. Okay, fiscal consolidation. Fiscal consolidation refers to the process of improving the fiscal health of the economy by adopting measures aimed at reducing the fiscal deficit to a sustainable level. FRBM Act was enacted in 2004. The Government of India has undertaken several measures to contain and reduce the fiscal deficit, which can be broadly classified into the revenue side and expenditure side. Okay, revenue front: tax revenue reforms such as introduction of GST, strengthening stable capital receipts through disinvestment and privatization, utilization of surplus foreign exchange reserves for external lending and investment in high quality sovereign bonds, rationalization of subsidies, salaries, provident fund obligations, implementation of pension reforms, reduction of interest burden through lower borrowings, repayment of fiscal FRBM Act 2003, enacted by Parliament of India with the objective of strengthening fiscal discipline, reducing India's fiscal deficit, improving macroeconomic management, ensuring effective management of public finances by moving towards a balanced budget. So it is basically to prevent fiscal deficit on a drastic scale. Objectives of FRBM Act we have seen: ensuring effective management, achieving macroeconomic stability, enhancing coordination, working towards goal of balanced budget. Currently we have a deficit budget, so the aim of FRBM Act was let us do one thing, let us keep a target that beyond 4% of fiscal deficit we would not exceed that limit. This is just an example. Let us see major highlights of the act: to reduce fiscal deficit by 0.3% every year, to achieve a fiscal deficit target of 3% by 8-9. Fiscal deficit and revenue deficits may be exceeded only under exceptional circumstances like war or any natural calamity, etc. Then we have government is prohibited from using RBI except through means and advances to address temporary. That means it is prohibiting from printing excess money to finance budget deficit or fiscal deficit. Finance minister is required to conduct a quarterly review of trends every financial year along with budget and demands for grants the government. Okay, fine. Fiscal policy strategy statement: medium term fiscal policy statement, macroeconomic. Let us see. The fiscal policy strategy statement specifies the government's fiscal priorities for the forthcoming financial year. It outlines the strategic approach relating to taxation, government expenditure, lending and investments. Okay, this statement represents 3-year rolling targets for 5 key fiscal indicators expressed as a proportion of GDP at market prices. Okay, macroeconomic framework statement: The macroeconomic framework statement provides an assessment of the overall macroeconomic situation, including GDP growth rate, fiscal balance of the central government, and external sector balance of the economy. It also covers aspects related to monetary management and financial intermediation, the banking sector, agriculture, and industry. Okay, medium term expenditure statement. This statement lays down 3-year rolling statement target. Okay, fine. FRBM Amendment 2012. The concept of effective revenue deficit was introduced. The focus shifted from targeting revenue deficit to targeting effective revenue deficit, and the target was mandated to reduce 3% of the GDP medium term. Okay, committee to review FRBM targets. So a committee was constituted under the chairmanship of N.K. Singh and submitted its report in 2017. It should be brought down to 3% of the GDP by 21, further reduced to 2.5%. Revenue deficit, it must be reduced to 0.25 per year and brought down to 0.8. Debt to GDP ratio, the combined debt to the center and states should be reduced to 60% of the GDP. This is important, with a limit of 40% for the center and 20% for the states accepted by the government. An independent fiscal council should be established. Okay, the central government should not borrow from RBI except under certain temporary cash shortfall. FRBM Amendment Act 2018. The fiscal deficit was mandated to be capped at 3%. The general government debt was required to be contained within 60% of the GDP. The central government debt was mandated not to exceed 40% of the GDP. Okay, fine. The government was restricted from using guarantees. Okay, any deviation from the prescribed fiscal deficit target in a financial year was limited to a maximum of 0.5%. In case of deviation from the fiscal year target, the government is required to state the reasons for such deviations by laying explanation before both houses of the parliament. The central government is prohibited from borrowing from RBI except through ways and means advances. Okay. Then we have escape clause. Escape clause was incorporated into the act through FRBM Act 2018. Under this provision, a deviation of up to 0.5% of GDP from the stipulated fiscal deficit is permitted under exceptional circumstances. So they have just given them a breathing window. Such exceptional situations include natural calamity. Okay, Government of India invoked this escape clause during 21. Okay, for due to COVID lockdown. In the Union Budget 22-23, Finance Minister announced that the government aims to reduce the fiscal deficit below 4.5% of GDP by 25-26. Okay, so that was it for the topic of fiscal policy of ESI, and stay tuned for the next topic, and thank you.